Next up, we have Ty, who is here to represent our Unicorn of the Year. Woo woo! Ty, we invested in Openly, Ty's startup, back in 2018. So been working together ever since. Ty has developed and built a sort of software native and now AI native insurance company. Background, Ty was, studied economics at Duke and MIT. He spent 13 years at Liberty Mutual, sort of rising the ranks in what insurance companies call product, which is actual like actuarial, statistics, underwriting of risk. And then he decided to take the founder plunge, after climbing the ladder all the way up to VP and getting a cush Liberty Mutual job. He decided to go work much harder as a startup founder for much less money. Thank you, Ty, for that. But anyway, we partnered back in 2019. It's been an adventure and an amazing opportunity. I don't know if you guys know this, but InsurTech has gone through its own sort of hype cycle and then some challenges, and the insurance market has changed rapidly. And so we'll get into some of navigating both, a market that has changed substantially, an end market that has changed substantially, and technology change at the same time. But thank you, Ty, for taking the time. And,
great to be here. Thanks for having me. I think that's me in 2019 before starting an insurance startup. So if you're ever thinking about it, talk to me first.
So yeah, actually, let's start off there. Like, what was your sort of founding story? What motivated you to, leave the executive job? And
yeah, no, it was a great job. It was also the month that we had our first kid, so I would also recommend thinking about that one if you ever contemplate it. But for me, I'm sure as with all of you, it was partly, I'd say, like really personal stuff and partly like the idea. So for me, the personal side was I was at a 50,000 person company. We plan on improving 3%. It was a good company, by the way. It's nothing, but we plan on improving 3% next year. And if we missed and hit 1%, it's like, well, that's a miss. And if we got 5%, it's like, oh, double bonuses for everybody. And it was just too little a spectrum of outcomes. And I realized I wanted to do something offensive. And so there was that personal side to it. And I had some contrarian ideas about the way I thought insurance would work. And in a big 50,000 person company, no matter how influential you are, there's going to be an element of like consensus and averaging that I just didn't want to put up with. Our idea, so we're, as Zach said, a tech-enabled insurance company, and I'd say there's like the things you'd guess, which are 40% of the money goes down a hole into administrative expense at insurance companies, and it's an awkward experience. And you would think they're really amazing at these underwriting and pricing models, but they're not really where you might think for a big sophisticated insurance company. There's opportunity there, and then there was an element that you might not expect, which was I had this contrarian thought that the future of insurance was more about consumer choice and layers of retail sitting between carriers of insurance, the product people, and the consumers, and the industry was going the other way. It wasn't investing in that at all. It was investing only in fully integrated direct companies. And so it was like those first couple things, and this little bit of a contrarian bet that we were able to make that led to Openly. So,
yeah, I think one of the interesting aspects about Openly is you have the fundamental sort of technological change as being like a truly software-based insurance underwriter, as opposed to most insurance companies are. There's a lot of human manual labor about underwriting risk, managing risk, collecting premiums, all that stuff. Like there's a lot of paper pushing, to put it in one way. But there's also they had a distribution hack, right? They had a premise for how you could build a more efficient business, but also still efficiently access the market. Which ties into actually part of the reason that some of the sort of V1.0 insurtechs have struggled a little bit. And by that, there were a couple of insurtechs, for those of you who don't follow it, that went public, Root, Metro Mile, and some others that struggled substantially on the public markets. I think one of the interesting reasons to frame this is, like, of course, we're in an AI sort of boom right now. Everyone's very interested in it, and we're at sort of peak interest, and hopefully, adoption and model innovation and all this just continues on that sort of accelerated path. But to the extent that we might endure a bit of a trough of disillusionment, if you will, maybe there's some learnings from a prior sort of trough of disillusionment. So, Ty, you're reflecting on, where InsurTech started when you raised your first couple of rounds, and then, it going through a bit of disillusionment. And just also for everyone's advantage, if you don't follow insurance, like insurance companies writ large, the entire market has been losing a ton of money for several years. Catastrophic risks are larger than they've been. Maybe climate change is a thing. I don't want to get political, but between hurricanes, fires are really risky. Hail, which we know a little bit too well. So the entire market has also been going in during this change, and that's creating opportunity if you can better underwrite, but it's also creating some of the overhang here. So I guess to put it to a question, Ty, like reflections now, 4 years plus, 5 years into InsurTech becoming less popular and people being skeptical of the opportunity. How have you endured?
Yeah. I mean, we're in some days it feels like we're this little boat on this big seas that are just churning, right? We have obviously the investment side, but we also are beholden to reinsurers who have their own crazy market cycles and one day love what we're doing and the next day don't for nothing that really has to do with us specifically. We have the weather, which obviously we can control to a degree how it affects us and make choices there. And I think through it all, I guess the two things I would. And by the way, I'm sure you all have had this too. But I mean, there's been so many nights when you're, oh my gosh, I've been spending 5 years on this, and that's it. I don't see a way out of this problem. Like that just happened. This big partner went away. Reinsurance market collapsed. The investment market collapsed. A giant tornado just went through Oklahoma. Whatever it is, and you don't see a way out. And there's been many nights like that for us, which we've so far gotten out of. But to me, it's what I think is. I'll go back to think of how a big company deals with some adversity. They missed their Q2 sales forecast. Okay, let's spend 5% more on marketing. Or we missed the unit economics. We missed the profit margin. Let's raise the pricing 5%. I think little adjustments. They just do stuff. I think what we as founders don't have the luxury of just doing a bunch of stuff. I think we have to be laser focused on the thing that is our mortal threat at that moment, right? And it's through our company, I can tell you, I think for just about every month of our company, what was the mortal threat? And I spend 95% of my time on that and 5% keeping the lights on. But so for us, for example, in 2022, it was all about reinsurance. That market was just collapsing from underneath us, and it was an existential threat. And so instead of continuing to build the product and hire people as I'd been doing and grow, instead I basically spent, a year on the road flying to London and Bermuda and just all day meetings anywhere, everywhere I needed to be to meet with reinsurers to kind of pitch our company to them. And we went from 2 reinsurers who really didn't like us very much to about 40 reinsurers who were bigger fans. Now that's not the problem anymore. That's not the mortal threat. But to me, it's that you just have to be extra clear in your thinking and not just do stuff. You have to do the right thing where the leverage point is. I also say don't believe the hype. I mean, we were just behind the hype cycle or just too late for it. So in some ways, I'm fortunate. We were never valued at $7 billion and then crashed back down. But as you all know, you'll have all kinds of people throughout your company's life telling you when the times are good, yeah, take this money, go spend it, do that, grow. And then as soon as the tide turns, they all just disappear and you're still standing there. And you're the one who has to deal with your burn and make your company work. So just make sure in the back of your mind, I'm a, unicorn, whatever startup, but also I'm a dry cleaners or something, right? Ultimately, the math has to work at some point, and if it's not, just ground yourself in that, even if you're not telling other people that. So,
I'll tie into that. You mentioned raising money, or for reinsurance. For an insurance company, that's kind of like raising money. It's just a different type. It's risk capital versus equity capital in your business. We've also now raised, hundreds of millions of dollars. And the equity markets, because you've gone through this sort of trough of disillusionment, has meant, maybe not the easiest raises. Any reflections on, because for many people, raising hundreds of millions of dollars sounds like a great success. And it sounds like, oh, that must have been easy for you. But reflections on what that actually endured or what actually took, and especially in a tougher market?
Actually, it was pretty easy. No, I'm kidding. Well, first off, as you all know, I mean, you just have to do. So I don't greatly enjoy raising money. There is an element of you got to find the bright light and the bright side of everything, right? So I think it is a great opportunity to focus your thinking about your company. It might change how you think about it. It might change your internal story to your team about, hey, that we put together this great story and that can help build momentum. But by and large, the process is not awesome. I hear some people really enjoy it, but I'm not in that camp. The uncertainty of it, but I think for us, it's been about, unfortunately, I think the answer is like, a lot of it is pure on just persistence. It's like, I mean, you all have presumably been through this, but you just never know what's going to work. And if it's the most important thing, you got to kind of really go after it. So like on those, reinsurance meetings I was talking about, we would have dozens, hundreds of meetings, and most of them were absolutely wasted time. But that was the thing that was going to make our company survive or not, and you got to do it. And the same thing with raising money, right? That's sometimes, often, all the time, your job, and you got to do it. I think certainly for us in particular, we had some pros, which was some of the pains in insurance were they brought some people who didn't know anything about insurance, which can be good and bad, right? And whereas our team had a little more of the depth of insurance background, so that was kind of a micro thing to us that I think helped us weather that storm. That was a little bit lucky, I guess. I had spent a lot of time recruiting people who knew about insurance, so that ultimately led to that. But it's pursuing it, chasing down every lead on the most important thing, even when you don't know if it's going to work. If it means flying across the world to Munich to meet with somebody for breakfast, you gotta do it. Not on everything, but on the thing that's the moral threat.
Yeah. So. Yeah. To that end, like I think from the outside, business that employs hundreds of people, does hundreds of millions in revenue, like raised hundreds of millions of dollars, can look like it was all up and to the right internally. It just want to reflect or share, like we've gone down in terms of employment at different points in time. Like how have you thought about when you had to get more efficient? How have you thought about the management and the leadership that it takes to tell what is a growth company, hey, we need to get more efficient, we need to lean out this team, or go through some of the harder times internally. Any reflections there?
Yeah, for us, tightening the belt, if you will, can be having to let people go and downsize your company because you're not to the revenue you expected to be. But it also takes other forms that really affect like our customers and our agents, where suddenly the weather's worse, reinsurance pricing is higher, we're way underpriced, we got to do just nuclear things that oh man, we spent all this time building up this revenue, and now we're going to go do this thing that's going to make some of the agents we work with and customers just hate us. But you have to do it. You have to be clear-eyed about the business will not survive unless we do this thing. I don't care. I care, but I don't ultimately care at a higher priority what it does to this other metric. You got to do it. For me, it's really important to, a couple things. One is you as like founders are going to bear a lot of the pain of that, right? Or a lot of the stress of that. And to do that, I think you have to get yourself mentally okay with it. And this is going to sound hokey, but like I literally have practices I'll go through in my own mind where I'll envision the worst case scenario. I'm like, been doing this for 8 years, but probably next month what if we just went bankrupt tomorrow because of some giant tornado, volcano, something and I'll work through it with my wife. I'll sit down and say like, okay, what would happen? Okay, well, our kids, they wouldn't be as spoiled as they might be if we have a big IPO. And like you can find, and I think literally thinking now you got to recalibrate and come back to, okay, well, we're not going to let that happen, right? But I think being able to face it and get yourself mentally okay with whatever happens and realize that like it's going to be okay one way or the other. I think that's important because then you can be calm with your teams. I'm really close to my direct management team, and I'll spend when something really bad happens, I'll spend a couple days just getting myself mentally in that place, and then go back and be really candid with them. They appreciate that, right? Because they signed up they all took big pay cuts, et cetera. They didn't sign up for the immediate financial benefit or anything like that. They signed up because of this like vision. And if you break that trust once with them where, oh wait, you've been saying this to us, Ty, but like you knew secretly that's not good. So I think now you can't do that with absolutely everybody in the company, right? But I think you gotta have some transparency with a core group that you trust and can get through it with. Because getting through it all alone, even though it's gonna be mostly you getting through it all alone, is not feasible either, or a very good idea for your sanity. But.
Yeah, I mean, I think that's, the highs and lows of being a founder and seeing wins like a customer sign or something breakthrough can be amazing, and it can feel like we're on IPO track, and then the lows, the missed opportunities, the pushed contracts or whatever can feel like, what were we all doing here and all that stuff. But the pressure, being the leader of the company, of course you can't really project those emotions. And honestly, we were on stage earlier and people were talking about, the advantage of being a second-time founder. I think one of the advantages of the second-time founder is some ability to sort of mute the highs and lows to quite the same degree. But I think practices like that and whatever can help you, rationalize it and get back to the leadership and control the things you can control.
Yeah, when I went from a big stable corporate job right to this crazy thing that goes up and down. And the first few times it went down, when we had some existential crisis, I wasn't ready for it. And I would think that just because I couldn't see the solution, that there wasn't going to be one. And I think after maybe like 5 existential crises, I realized that just because it might take me a month, sometimes it's taking me a month to figure out in the early days, especially what is the solution to this that could conceivably work out. But now I have some faith that it's not, it's on the other side of the horizon or whatever, but it's there. I know we'll find it. We always have. And I'm sure second-time founders probably come to it with that. But I will, just to reiterate, it doesn't get easier. I mean, you can talk to people at companies that are way more successful and farther along than us, and I think they'd say the same thing, which is you don't trick yourself into thinking, it's going to be like this for another few months, and then once we get that Series B or C or D or E or whatever, suddenly no. So you have to be sustainable. Your mental state has to be sustainable in this world, probably for a long time.
All right, now one thing that's very, I think, different or unique about Ty's business is that, while maybe a majority of the folks in the room or maybe a majority of startups try to go sell software or sell technology to the incumbent businesses in a vertical or in the space that do other things, Ty and the Openly strategy has been to build a full stack insurance business. Now, it's a software native insurance business, and that's going to give it a lot of operating leverage. It's more dynamic. It can adjust to market risks more quickly than legacy businesses. But you could think about trying to sell that to insurance companies and get them to adopt. Why did you not go that path? I think there's multiple reasons, but can you share a bit more of?
Yeah, look, there's obviously pros and cons to both paths. And when, a big tornado goes through Oklahoma, I'm like, well, we should have just sold software, huh? But ultimately, I think to me, it's about how to what extent can you disaggregate some vertical? And I think a lot of it depends on how cleanly the information will flow between the different parts of that vertical, right? So there is a model where we could be just a distributor of insurance, or we could be just a software provider. The problem is the information in insurance is really, really complicated. And so if we were trying to sell anything to the ultimate risk bearer, who owns the balance sheet, who's going to make money or lose, they are highly and understandably distrustful of what you're doing downstream in that value chain. So if you try and go just distribute business and let them take the risk, or if you try and sell them software, they're not going to trust it. So it's going to be a 3-year sales cycle. You're also to connect whatever you build. Let's say you just want to sell software, whatever you try and build, boy, does it need to be not. It needs to have a very narrow interface point with whatever their system is. And the problem is a lot of the stuff that really adds value to their software has a lot of interfaces. It's complex, so you may as well just build their whole stack for them. But then you've built an insurance company. So it's our biggest advantage, for example, is probably in if you were to just say what's the best thing that we do that's most differentiated, it's going in and a consumer gives us name, date of birth, and address. And we, based on that, go out to a bunch of different data sources, put it through all these ML models, bring it in and give back all these answers. Here's your rate, and are you eligible? Here's your rate. Here's the commission we'd pay an agent. Are we going to have to inspect your property? All this stuff. But that is so tightly coupled with everything these big companies do that it's just an impractical sales process. So So we had to swing bigger. I guess bigger is maybe the wrong word, but much more vertical, and do what arguably feels to us like a harder thing. And sure, what we are now, we're like a hedge fund attached to like a paperclip company or something, right? It's like because you've got this serious operational wing to the company that's just got to execute stuff over and over in a good way. But then you've also got this highly quantitative part of it, which is the part that we kind of originally built the company to succeed at. But you can't do just one without the other. We've learned.
I think because we're in like the AI agent age, I think it's an interesting reflection because there's, do you go try to sell into every business and offer them, horizontal, like we can be every agent for all of your workflows? Do you go try to sell like the finance agent or the, something else? Or do you go try to build like an external expert so you could offer those services, like you could be an accounting service or whatever? Like these are the same like horizontal versus vertical decisions. And in insurance, candidly, I made several other insurance tech businesses. Shout out young Alfred founder, no offense, but like the software selling into insurance today to this date has been the wrong decision. Like the go vertical, build it yourself has been the right decision in this vertical. And so that's not to say, every vertical has its own trade-offs, but definitely, think about, and if there might be the opportunity for some of you to pivot from the software sales to a full stack business if you need to be able to control, like Ty was saying, especially like the full stack of data and trust and information.
The world would be better, I think, if we were a thin vertical layer, but there's not enough trust to make that happen, right? No one wants for the insurance industry to spend 40% of people's money on admin expense, but to solve that, they'd all have to like trust us to do it for 20%, but trust us, and they're not going to do that. So It was
the other, one of the things I've been, impressed by with this business is that as you've scaled, a C-suite, VP suite has always been kind of, filled out, I think, and filled out with, really high caliber people. And, candidly, one of the things I see in different businesses that get to the Series C and the Series D and beyond is often there's not a sort of leadership C-suite or VP suite, or it's like kind of always churning. And so I just wonder if you have any, reflections about what it took to attract and retain those people.
Yeah. So I talked a little bit about, what's the moral threat at any moment. And for a while there in the middle, it was reinsurance. But in the very early days, it was people, right? It was, the very, very early days, it was getting the PowerPoint right to like raise the first dollar, but after that, there was a period where it was people. And I spent, just like I traveled the world for reinsurance, I was in Boston at the time, and I spent, my main job was doing the coffee and dinner circuit and, going, and just people I knew from prior lives or networking in some way, people I didn't, and just trying to sell people on the vision of what this is, because we could not possibly offer them, the comp that they're making at some big carrier. So we ended up getting people at 1/20th of the cash comp that they were leaving in many cases, or that they would make it a big carrier, because they wouldn't work for that forever, but because they were buying into this vision of, and so I think one thing that big companies I think actually do pretty well is one version of playing the game of being a corporate executive is you build this like talent empire, and I think that's got its own weird anomalies that go on with that, but it does at least teach you that talent is really important. And I think a lot of people who just have ideas and are starting a new company, haven't been in a big company, may not realize how much a part of winning that is. But they trained me to do that because my corporate stuff, and so I think I just put a lot of focus on that for a couple of years. Now, it's still a huge focus, but it's a little bit less about like rabid recruiting and more about over and over selling the vision. So the only other maybe piece of thought I would give there is you got to constantly be looking for those opportunities. You just had a board meeting and you brought your stuff together in a way that really kind of sang, or you had a investor raise that kind of sang. Always be looking for opportunities to keep repeating and selling that vision to your company. Even your directs may not get X, Y, or Z about what's going on, but certainly people elsewhere in the company don't. And I think everybody, including me, makes the assumption that people know what's going on and what the vision is when they don't. So say it like 6 times and invest in that. And that's what will get people to want to keep working, engaged.
And again, for that same C-suite that are like, the VPs, the C-suite, they do see when there's some bigger problems in the business. And so you do have to have that leadership to continue to retain them, because they not only are they passing up on, better comp when they first accept the offer, but don't forget, like if you have great people, they're passing up on alternative offers all the time. You just maybe don't know about it. So last question for me, and just something I always like to ask is, if you were to reflect back, 4, 5, 6 years ago, when you
8, but who's counting?
8, yeah. There's a theme to this, by the way. Like, I don't know if folks who were here last year, like, Stephen from Lambda was on stage, and, he had been at it for 12 years. These are like, overnight 12-year successes, or 8 years, or what do you wish you knew earlier? What would you tell earlier Ty?
Well, I wish I knew the hailstorms were going to like double in 2023. I might have gone to Florida instead. But no. I think, so there were a lot of companies that were kind of in our peer group of insurtech, maybe just before us in some cases, that burned just an enormous amount of money. They raised huge valuations and burned a ton of money. We were fortunate not to quite be on that wave, and that's causing a lot of problems in most cases. We were fortunate not to quite catch that wave, but I will say even so, I alluded to this earlier, I think so my brother-in-law, it just started a car dealership, and this isn't like a VC, but it's like, got to make money in like month 2, and and I think that's one extreme, and then there's the like VC backed, oh my gosh, rocket fuel, and I think you always keep your eye on that spectrum, because the burn that everybody in the ecosystem will tell you is okay, is fine, until one day it's not, and then instantly it's just you standing there. It's like you're all like there, and then it's you. So I would tell myself, boy, just fight back every instinct against your investors, your directs, whatever, against anything that increases your burn, and as quickly as possible get to a glide path to break even. Now I'm sure that violates the stage where many of you are and whatnot, but that's my honest answer is have your eye on that more than anybody else. So.
I think it's a good point, and I think there's reason right now to rethink like burn as it is. Like in most software startups, for example, you spend all your money because you have to do on who's building it and who's selling it, and you have to build it ahead. So that's like the cash flow cycle where you need to invest in R&D, and then you have to sell it, and there's customer acquisition costs before you have long-term recurring revenue. Both of those things are showing pretty high leverage with AI tooling, right? Like engineering is obviously seeing a lot of leverage, and I think we're starting to see sales teams with a lot of leverage, and so you might not have to have, half the sales team you used to have a third or whatever. So I think, at the earliest stages, there's still like kind of a minimum get off the ground, activation energy, but then, keeping your business plan where you have the upside case, but the downside case isn't such that you run out of capital is a good priority to have. So, well, thank you so much, Ty. Appreciate the conversation.
Thank you.
And congratulations.
Thank you. Thank you. And I'd be remiss not to say Gradient's been awesome for us, as I'm sure they have for you all as partners. So thank you for all the support through these last 8 or so years. So.
You got it. 8 more to come before we go public?
Let's shade that down a little.
Yeah.